scores of books on Civil War. So I thought, this would be a money class. I got a C in it, and I struggled. This guy, renowned author, he was a visiting professor.
Well, that's the worst one.
And, well, no, basically a lot of times what he wanted to know is who wrote the book. Well, I knew what was in the book, I just didn't know who wrote it. You know, I didn't care who wrote it. And, but he was, obviously, when you're reading 50, 60 books, you're into that and you know all these people. But I'll never forget, we had like 10 multiple choice, 10 fill in the blank, 2 short essays, 1 long essay, and we had 60 minutes to do all of it. And one of the essay questions, I can't remember if it was the short or the long one, was describe Davis and Lincoln as presidents of the respective nations. I gave 7 positive and 7 negative on each one. That's 28 points. Guess what the comment was?
Not longer than that.
Not enough. Not enough. No, like 28 points on one question in higher test. But that's the way it was. Yes, sir. I mean, it's like Animal House. Thank you, sir. May I have another? Whack me again. But you guys don't. I know you don't believe me, and that's the whole thing. But it was totally different. The only time I went to ask the professor, how come I got a C on midterm? He goes, "Oh, yeah, I remember your test. Grammar was correct. You had plenty of facts, and they were all correct." So I'm going, okay, what else do you grade a history test for? But read the style of the same paper. I read 2 paragraphs and handed it back to him. I knew exactly what I'd done. I hadn't put it in his words. I put it in my words. He wanted me to phrase it the way he said it. And I knew I was getting a C for the semester no matter what. And there were people out there like that. And they may still be here today. I don't know. But, and I was like, it was like, yeah. Of course, there was another class, theory class. It was Thanksgiving before I figured out what the guy was saying in a fall semester. I mean, I'd get C's on the test. The guy sitting beside me get B's, and I'd read his answer, and I'd read mine, and I still like mine better. And I just couldn't figure the guy out, what he was, political theory. I mean, this guy was way over my head. Then he got to Thoreau, and then I understood Thoreau. I could deal with civil disobedience, and what that meant and all that. Playing again? Like you're doing that? Okay. Let us get into, I know you want more variances. Right? Everybody. Well, oh, by the way, I did change due dates on the intermediate.
Oh, yeah, we have.
No, you already noticed that? Well, I just did it a little bit ago. Just a little introduction here. Friday afternoon, everybody's real into it. Y'all read this chapter. Just anxious to go on. I can tell by Lexi's expression.
Rough week.
Think of it this way: 4 weeks from tomorrow, it's all over. That's the good thing. Y'all don't realize it. Professor counting down. And, okay. Basically, what they're talking about here, if you look at the first part of the chapter there, it's what they're trying to get here is, we start talking about analyzing the variances, and one of the first things we look at is, unlike the prior chapter when we were dealing with material variances, and that question on the test where the amount of materials purchased and the amount used was the same, that's not always so. You know, when production's greater than sales, you know, the amount purchased and all that, the amount used will be different. And so, when a little bit ahead of ourselves right now, but it's what I told you earlier. couple classes ago. When we're doing the price variance, we're doing that at the point of purchase. You're basically debiting materials, crediting accounts payable, and you've got your price variance. And the thing about it is accounts payables will be actual. If we're doing a standard costing system, materials is debited for standard, and the price variance obviously is what's going to. And the price variance is going to be the responsibility of the purchasing department. Now, we still do the materials efficiency variance, but that's when materials are placed in production. And there can be a time lag and can be different amounts. Beginning inventory and ending inventory is not always going to be the same. It can increase or decrease. So the amount of units that we're putting in production is going to differ from the amount we're purchasing. And so when you do that, the thing that we'll look at, you'll find out is you really can't say what is the total material variance because it really won't mean much because you're talking about different amounts of units at different points in time. The thing about here, if we talk about the assumption that production is greater than sales, it won't have any effect on the sales activity variance because the master budget, flexible budget are going to be based on the sales volume. And so is the price variance and marketing administrative variances. But and he's getting ahead of himself. Yeah. And looking at those profit variances, you're going to find out not going to be any real change with the difference in when production and is greater than sales, vice versa, because we are dealing with that. Basically, what he's trying to tell us here is what do we do with this overhead price variances here that we have here, varying manufacturing costs 28,890, the fixed overhead variance there 4,500. Most companies, as he said there, will simply close it to the cost of goods sold. Now, basically, all we're doing is we're going to debit cost of goods sold, and if the variances are unfavorable, you credit the variance. Again, it's I'm trying to think. Had it on the tip of my tongue. Anyway, but if we the simple way, and you say which system would the company choose? Well, again, it's one of those what Uncle Bob want, what Uncle Bob did years ago. But if your variances are not really material, then it probably makes just as much sense you close it strictly to cost of goods sold. Now remember, if it's unfavorable, you would be crediting the variance to close it. If they're favorable, you'd be debiting that variance. Cost of goods sold is just the plug figure here. Now, some companies want to prorate those variances. Well, then again, let's assume they're all unfavorable variances. You would credit the variances, and then you would debit cost of goods sold and finished goods. And you say, well, how much do you prorate it? Well, let's just make some numbers and show you. And you know how to prorate things. I don't know why I popped that up. You don't get good examples to begin with. All you would do would be a simple allocation. Again, we would just look at, that's worthless. You would just look at the T account for finished goods, and let's say it's 800,000. I'm just making numbers up here. And I'd look at cost of goods sold. And let's say it's, for ease of simplicity, I'll say it happens to come out exactly to 3.2 million. Well, now, if I've got variances, no matter how much the variances add up to, if they're all unfavorable, again, I would credit those variances, get rid of them because I got a debit balance. Again, this is a classic example where in the real world, you would have these accounts, you could look at your ledger, it makes life a whole lot easier. But you would look to balance. If they're a debit balance, we got a credit to get rid of them. If they're a credit balance, we got a debit to get rid of them, right? but you come up with the amount that's the plug number of all those variances. And I would simply add up the 32 point plus the 8 million, and that's 4 million, right? And that, if I did my math right, that's what, 80%? So whatever that plug number I need to make the journal, all those variances, the sum total of all those variances, 80% of it I would debit the cost of goods sold, 20% of it I would debit the finished goods. Again, we're just prorating it. Now again, why those two accounts? That's where the variances are, right? We're recording, generally we're talking about finished goods here, so it's with the finished goods, and as water flows downhill, all expenses flow into cost of goods sold. Now again, if the variances are not that material, I just go ahead and debit cost of goods sold, credit the unfavorable variances, debit the favorable variances. So the journal entry there is not that extreme, not that hard to figure out in coming up with it, right? And so, you know, making life a little bit simpler in how we get rid of these things. And yeah, let's see. I can't make up all these numbers at once. Okay, here we've got the accountant S Toys is analyzing production cost data for its trucks division. For October, the actual results in the master budget data is presented. And so we can look there, and again, average cost there. We got total variable 12,680 a unit, actuals 11. And we got fixed overhead 9,000, our actual, and budget was 9,600. So we're talking about, we're probably going to come up with some positive variances a little bit there. Now it says, prepare a profit variance analysis. It's a manufacturing variance. Master budget. As we see there, our master budget based upon 12,000 units, 168. And everybody okay? This is sort of a little repeat what we've done before, but how we're getting these numbers. And notice the flexible budget of 10,000 there. As we see that sales activity variances there. And notice here we have a 10,000 favorable sales price variance, 10,000 more. But notice our materials, labor, and overhead all unfavorable, but our fixed overhead was favorable. But again, this is sort of just a repeat of what we've looked at before, comparing our actual to our flexible budget to our master budget. Sales activity variance, again, is just the difference between your flexible and your master. Sales price variance, self-explanatory. Actual versus flexible budget, and the others are flexible versus actual. Now, in recording these, again, we would simply debit our cost of goods sold and credit, in this case, our fixed overhead price variance, our fixed overhead production volume, our variable production cost variances. And again, if you want materials price variance, material, you would simply go through and name them and credit them. Now, in coming up with how we do those closing entries and when we do it, it depends on what type of costing system we're using. Now, does anybody remember the 3 types of costing systems there are? Well, which one have we just been talking about this last chapter? Standard costing system. That's one extreme. What's the other end of the spectrum? Actual. And then what's the one in the middle? Anybody remember the name? Normal. So you got actual, normal, standard. Under a variable costing, the entire fixed production cost is going to be expensed when incurred. We just go ahead and report everything. In normal system, remember, some of that overhead will not be expensed until sold. Some of it goes into ending inventory. In standard, full absorption costing is used, and again, that sales volume are not the same. The profit that we report, some of that cost is going to be an asset. If you'll go back and remember prior chapters, we move over standard overhead. It's not expensed until sold. The actual costing overhead is considered period expense. So we can have some differences there, depending on what system we're using. Now, get into volume and market share variances till Monday. Let's look at problem 22 and we'll finish up on that. And what we will do is just deal with the first part, back with what we've done with materials. Johnny's Weeds Be Gone yard service sprays lawns to avoid them of weeds. John mixes 2 chemicals, Weed X, pesto in proportions depending on the climate and particular weed problems of the season. Standard mix cost for a gallon mixture to combat equal parts of Weed X, pesto. Weed X has a standard cost of $8 a gallon, and pesto has a standard cost of $20 a gallon. Each gallon can treat 100 square yards of lawn. They expect to treat 900,000 square yards of lawn. In the past season, John treated 80,000 square yards. He used 66 gallons of Weed X, 52.80 of pesto. He paid $51.150 for Weed X and then $110 for an $8.80 for pesto. So it says compute the materials price and efficiency variances for the season. Anybody got any idea where in the round head we start at? What's the formula for coming up with a price variance? Anybody remember?
Actual times actual minus actual times standard.
Okay, so you can do it several different ways, but like I say, the way I do it my way, fine if you want to do it a different way. One, we got to do Weed X and pesto different. Let's do Weed X first. Again, material price variance. Okay, Weed X, and we'll do pesto over here. We can do the actual and standard. Which one of these two price per unit we got here?
Actual's $8 a gallon.
$8 a gallon?
Yeah.
How can we get the actual cost per gallon? Guys, let's think about this. It tells you that how many gallons did he use?
6,600.
6,600. What did it cost him?
51,150.
51,150?
Mm-hmm.
So did we not do something like this times, you get that? Could we not say? So could we not go 5150 divided by 660 is how much per gallon?
$7.75.
$7.75. And guys, little tip, on the test, y'all were getting variances of 100 and some thousand and all that. Usually not going to be that great unless we're talking about huge numbers. But notice here that $8 is our budgeted gallon. Remember one of the first things I said, always look, check, make sure your standards are somewhat reasonable. So if my standard's $8, I sort of figure my actual price is going to fall somewhere around there. If it's not, I might want to start thinking, am I doing this right? But again, I come up with $7.75. So again, a difference of 25 cents, right? Now right off the bat, am I going to have a favorable or unfavorable price variance here?
Favorable.
Favorable, right? I'm paying less. So I'm going to multiply that 25 cents by what?
6,600.
6,600 gallons. And that's going to give me what?
1650.
1650 favorable. Right? Everybody okay with that? Tell me what it is. What's the price variance on pesto? Can you do that now?
Would it just be 5280?
It would. How'd you get that down?
I took the
What's the actual price?
110,880 divided by, you mean the per unit?
Yeah.
Oh, I'm sorry, $1 or $21.
Yeah, $21 is that. And again, that's simply taking the cost price, you said it was 110 whatever,
880.
880, and divided by how many gallons were we actually?
5280.
5280, okay. And then my standard cost was what, 20? So I have a difference of $1 times, again, give me the actual units, 5280. And so I do have a variance of 5280, price variance of 5280. Favorable, unfavorable? Unfavorable. Okay? Everybody kosher with that? We'll do efficiency variance now. Now again, what we got to look at is difference times standard, right? Difference of amount used. What are they telling us? We used on Weedex, we used 660 gallons, 6,600 gallons. How many should I have used? Hmm?
1,080.
1,080?
Hold on.
10,800. Or
What's the trick here?
we've got two separate sprays. You have to divide it.
That's the trick on this problem. You say, what do you mean? We actually should have used, if we were using a gallon per square footage there, 100 square foot of what in it, we should have used 10,800, right? But he mixes them, don't he? We're not using 10,800 of Weedex and 10,000 pesto. We use a 50-50 mixture, don't we? That makes sense? So actually, we should be using 5,400 gallons of each one, right? Everybody with me? Now, let's do our actual and standard. Okay, how many gallons of Weedex did we use?
6,600.
How much should we use? Was it 5,400?
5,400.
Yeah.
Okay, make sure I'm getting it right. Okay, now, yeah, that's right, done. That's 1,200, right? What do I multiply the difference of 1,200 by?
$8.
Our standard price is $8. So that's what, 9,600? Favorable or unfavorable? Unfavorable. We use that. Now, on pesto, actual, how much did we use?
5280.
5280, and we should use 5,400, correct? So that's 120 times the standard of 20. What is that? Favorable, unfavorable? Let's see if we get it correctly. I'll check in. Yep. Now, what we're going to look at Monday, we're going to break down that efficiency variance into a mix variance and a yield variance. In other words, we're going to take it 9,600 unfavorable on Weedex and try to come up to mix and yield variances. And same thing with that 2,400 favorable for the pesto.